Welcome to Tycoons of Small Biz, a podcast designed for small business owners, the backbone of the American economy. Join us as our hosts Austin and Landon share insights and experiences as small business owners, active investors and operators who have started, bought, sold, and grown several successful businesses. Tycoons is powered by Backbone Planning Partners, a business consulting and wealth management firm built specifically to serve small and medium-sized businesses.
Hello, Tycoons, and welcome to today's episode of Tycoons of Small Biz. I am your co-host, as always, Austin Peterson, with my other co-host, Landon Mance. I'm coming to you from Phoenix, Arizona. It's a little gloomy today, but hopefully we'll warm up and let the sun out a little bit. And Landon is in Las Vegas. Landon, welcome in, buddy.
Pleasure to be here, sir.
How's it going?
It's all good, man. All good. Last couple of days have been absolutely beautiful out here in Vegas. Been spending about 3 to 5 hours a day sitting in my lawn chair in my front yard, letting the twins run around the street with all the little neighbor kids, and it's been a blast.
Awesome. Sounds like a great weekend. That's what. So President's Day weekend, my wife and I went camping for 4 days, and the weather was just perfect. We hiked 15 to 20 miles, somewhere around there, maybe 16, 17 miles throughout that period of time, but also spent, I don't know, probably 4, 5, 6 hours just hanging out in a hammock. So wasn't a bad weekend for sure.
Nice. Were you sitting there eating any delicious little cuties?
I did have a few cuties, actually. Had some in the fridge of the RV, and I love a good cutie. I actually ate one on each of our hikes except for one, and I did have one in my pack, but when I opened it up, it was a little rotten, so I ended up eating it.
Gotcha. Yeah, I can't go wrong with cuties right now.
Yeah, you're just having a really hard time not eating that live on camera, aren't you?
I am. We'll see. I think I've got the restraint to not peel this puppy open, but to be determined.
Yeah, we'll see how it goes.
Yep.
All right. So last week we talked a little bit about early stage investing or private investing, the different options, and so today we're going to kind of narrow that focus a little bit and talk about angel investing versus venture capital. So why don't you just give our audience a little bit of a definition or a differentiation between those two, because I think they get I don't know if they get switched, or people look at them or think they're the same thing, but there's a clear delineation between the two that not everybody fully understands. So maybe kind of start there if you don't mind.
Yeah, absolutely. When I think about angel investing, well, the first word that would come to mind is extremely difficult. Maybe that's 2 words. But it's hard, really, really, really hard. And we'll talk about why. If I was to define angel investing, it would be writing small checks. Generally, check sizes in angel investments are going to be as low as 5 or 10,000 up to 25 to 50,000. Those are going to be generally the check sizes. Most angel investments are going to be in essentially a concept, right? An idea, for the most part. Most angel investments that people are making, the businesses are pre-revenue, generally pre-customers. So it's really just more of an idea and a concept. I would argue that you are investing in the founders, in your confidence that they are going to be able to execute on what they're setting out to do. It's not always going to be pre-revenue. Sometimes, they'll be at what's called like a seed round. So at a seed round of an angel investment, that's when generally you start to see like venture capitalists getting involved because they've got some kind of traction going, right? They've got some customers, they've got some revenue, they've got some kind of a product market fit, if you will. So there's some kind of validation there. Venture capital generally. Oh, let me mention one other thing. Angel investing is generally going to be done by friends and family, your close network of people. A lot of time, angel investors are exited founders who have made, a decent amount of money from transacting in their business, and now they want to go out and be these, professional investors, and they tend to start with angel investing. All right, so venture capital investing. Venture capitalists are more professional, so they do this for a living. Maybe they're starting out with their first fund, but they generally have some kind of direct experience as an early stage investor, and they've pooled together money, generally their own money, as well as other investors' money, which are typically going to be called limited partners. And the VCs have pooled together money, and they have a thesis to go out and to invest into companies. Maybe it's, early stage tech companies. Venture capitalists are going to write checks, maybe as small as $25,000, up to, call it, $250,000 in the early stages. But venture capitalists will invest at many different stages of a business life cycle. Some now even invest at that earliest stage, which is really that concept or idea stage. And then the next stage is kind of like seed. So they've got some kind of traction rolling. And then after that, you come into Series A, Series B, Series C. These are much more established businesses. Generally will have hundreds of thousands or millions of dollars a year in revenue, and the check sizes will be much larger at those points. They could be, a minimum of hundreds of thousands up to several $1 million of kind of growth capital. I'll talk about a venture capital investment that I've made, and they're doing a follow-up round, so they're raising additional money, but for the same company. So that kind of encapsulate angel versus VC, just at the most kind of elementary level.
Yeah. I mean, I think if I were to distill it down into just a few words for each one, I mean, angel investing is typically individual investors inside of your close network, concept to startup phase. And then venture capital is typically a fund where they've gotten a bunch of investors together, but the fund as a whole is investing in a company that's either somewhere between early stage all the way up to potentially an IPO. So they can be involved in a very long period of time with multiple deposits, like you said, or multiple investments throughout that period of time. So concept, startup, individual investors, professional fund, early stage all the way to IPO.
Yeah, well said. All right, so let's talk about the pros and cons. We'll start with angel investing. So to me, I think the biggest pros of angel investing are really that you are helping these businesses survive that first stage. Because in order for them to get to their kind of initial stage of survival, if you will, they need capital to work on their product, They need capital to make a couple of hires. They need capital to they need capital to just get the business off of the ground. They might need to rent, a small space. Just the very fundamental things that you need to get a business off the ground. It helps with that. It also helps to give a lot of confidence to the founders that somebody believes in them enough to actually invest in their idea or their concept. So that's a big pro. Another big pro of angel investing is that if you invest in an angel deal and that business actually takes off, the return on your investment is going to be very significant. It could be, 30, 50, 100x, 100 times your initial investment. So if you invest, 10 grand and the business really, makes it, so to speak, you could get back $1 million on your 10 grand that you invest. Okay. So that's an obvious pro, is that the upside is really, really significant if the business does do well. But as we know, in angel investing, that's generally not going to be the case. Most companies at the angel investment phase do not make it. I'm not exactly sure what the statistic is, but the vast majority of companies that start out taking angel investments, they go absolutely nowhere. They burn through a couple $100,000, couple $1 million of cash over the course of, call it 1 to 5 years, and they never find product market fit. They never find enough customers. They never find traction, and they shut down. So, biggest pros, I guess, are supporting the founder, big opportunity for upside. If you are somebody that has a lot of experience in a particular industry, you can be extremely valuable to the founder as an angel investor. So that's a big pro as well. But I don't know. What do you think the biggest cons are, other than the fact that they've got a really small likelihood of surviving?
Yeah, I mean, that's definitely the biggest con, right? Is I don't know the exact statistics, but typically 1 or 2 out of 10.
Yeah.
So 10 to 20% is typically what you can expect to hit in terms of angel investing. And so, we mentioned on our last episode that you really need to be making somewhere between 7 and 10 investments in angel companies in order to be able to hope to get some sort of a return, right? And so that's the thing, is those 10x to 100x returns on your money, if they go and actually take off and do well, that sounds tremendously good, right? Which it absolutely is. But you've got to also factor in that 7 or 8 out of 10 aren't going to make it, right? Maybe even 9 out of 10 aren't going to make it. So you're going to lose all of your money there, but then you may get 10x to 100x, return on the 1 or 2 others that are there. So that's absolutely the biggest con. I would say the other big con is most of the time it's some sort of a concept that you don't fully understand, and you kind of look at it and say, oh gosh, yeah, I never thought about that, or that would be really cool. And you think, and the founder helps you to think, that the market's larger than it is, or that there is a market for the product, period, right? Because sometimes something seems really cool and you think, oh yeah, I would use that, but nobody else would, right? Or at least it can't get the traction, or they can't raise enough other angel investment to go out and really give this thing a push and push it forward. Or you can't get it patented because it's already been patented, or it infringes on somebody else's patent. So it's just the unknowns or the misunderstandings of or lack of understanding, I should say, about what's being launched and the potential upside.
Yeah, good points. Another thing that just came to me as you were saying that was there's two other things that make angel investing very challenging and very risky: liquidity and time frame. So when you make an angel investment, just wipe your hands of that money, because if you are getting anything back, it is going to be 5 to 10 years minimum, and it can be 10 years plus before you see a penny of that money back. And I'm sure they have happened out there. I've never heard of one happening like this, but I'm sure they're out there. But also, don't plan to get any capital return to you other than if there's some kind of a transaction. So it's not going to pay you income or dividends along the journey. It's kind of like an all or nothing type investment, you know? And then, yeah, time frame, I guess I just kind of alluded to, but when you make an angel investment, that's, you know, you're committing to that investment for 10 years, because it's highly unlikely that anything is going to transpire in less than 10 years. So plan on holding that for about 10 years. You've got no liquidity essentially. So there's no way to get your money out if you need it. But on the flip side, if the investment does take off and actually make it, your return is going to be really, really significant. There is another, so angel investing, just like everything, you know, the last, 3 to 10 years has evolved. And now there's a lot of different ways to get into angel investing and to kind of avoid some of the pitfalls that we have alluded to. And now they've syndicated angel investing, which means that they've created vehicles to invest in at a much lower price point. So call it, $1,000 or $5,000 or $10,000, and they're pooling capital together from people. So maybe this vehicle, this fund, whatever you want to call it, maybe it will raise, $200,000 or $500,000. You've only put in, $1,000 or $5,000, and then it's going to go out and make, 10 or 20 investments. So there are new ways to do angel investing to where you can write smaller checks and diversify into many different companies through what are called syndications. So those have become a lot more popular in the angel investing world the last, couple years.
Yeah, no, no doubt about it. I mean, there's, what comes to mind is, is a company like Kickstarter, right? And so, that's somewhat like that, where you're essentially pre-ordering different products, right? But there are vehicles, like you mentioned, in that syndication where it almost acts like a Venmo, if you will, where you're just contributing a certain amount, and it can be really micro amounts into this where they're going to go out and make those investments on your behalf. So it's angel investing that's acting like venture investing, which is kind of a unique or new spin on angel investing.
Yeah, definitely.
Yeah.
Well, let's talk about a couple examples. I can give a couple examples of some angel and VC stuff that I've invested in, just to give people a little taste, little flavor.
Well, let's talk about the pros and cons on the venture side before.
Oh, okay, yeah, let's do that. Good call.
Yeah, so I mean, the pros and cons are similar on the venture side, or maybe even kind of the opposite, right? Where a pro may be that on the venture side, you're putting money into a fund that is presumably operated by somebody who does this for a living, or a group of people who do this for a living, have more experience, more knowledge, more know-how, more ability to look at financials and look at, the market as a whole than you have access to or have the ability to do. So that would be a pro. But I'll give you the flip side con of that. And the con of that is that you're giving up full control. You're essentially giving them your money and the ability to make the decisions on your behalf. So they're literally making the decisions on which companies to invest in, at what stage, and at what amount. And you have no control. They're making that decision for you.
Yep, absolutely. And again, there, just to that point, there are pros and cons to that, right? Because seasoned, experienced venture capitalists, they've been making investments into companies for years or decades. So they've seen a lot. And so they are very skilled at, picking great founders and great, early stage companies to invest in. But similar to the world of angel investing, a lot of companies, they're called VC-backed companies, so venture capital-backed companies that have been invested in by VCs. Majority of them also don't survive. So their odds are a little bit better, but not a whole lot better historically. I'd say another thing that's really something you need to think about with VC investing is around alignment, because venture capital investors, they want to invest capital. They want this company to grow, generally at, 100 to 300% a year. And then they want to exit out of that investment in a, like a 5 to 10 year period. That's kind of like ideal for VCs. They want to dump a whole bunch of gas on the fire. They want that thing to just start roaring and firing on all cylinders, and then they want to get out as soon as possible through a sale to a strategic, like let's say it is a CPG company, consumer. What is it? Consumer product good or?
Yeah.
So they're a CPG company. They're a women's, deodorant company, and the company takes off early, and they get some VCs to invest in them, and all of a sudden they're in, all the major grocery stores, and they've got a great Amazon presence, and then they sell that to, Johnson & Johnson or something like that for, 300-500 million bucks or something like that. That would be like a strategic kind of exit. Some will go public. A very, very tiny fraction of companies will grow and actually, go public. But alignment between founders and VCs is a big challenge, because VCs want to grow at all costs, and that's not always the same game plan that a founder has. So you gotta make sure that there's a lot of alignment there between VCs and the founders. Otherwise, you're going to see a lot of headbutting.
Yeah, and I would just say, as a founder, right, if you're looking at venture capital financing, that you've got to go in with your eyes wide open and understand that those are some of the cons of being VC backed, right? I mean, they're going to want to make more decisions. They're going to have their way of doing things and what they want you to do with the business. And depending on how much you're giving up and board seats and all those sorts of things, they may be able to push you out as the founder, not take away your equity per se, but push you out in terms of decision making and turn this into a company that's completely different than what you ever thought it would be. And so, that's one of the cons potentially as well. It can be a pro as well, right? Maybe they're better at making the decisions and they know which direction it should be, and they're going to create, lasting wealth for you and your family. but it's important for you to go in with your eyes wide open as a founder and understand what it means to be VC backed.
Yeah. Excellent point. One thing that I have come to realize with VCs is that there's a couple things that I think give a VC a leg up, and that is their experience and that is their network. Because what I am seeing with a couple of VCs that I invest with is that when a VC backs a later stage company, a company that's looking for growth capital, right? They've already found product market fit. They've already got, millions or tens of millions of dollars of revenue. They may not be profitable. They're most likely not profitable, but it's a mature business in the sense that it's been around for many, many years. It's got a solid management team. They're doing millions or tens of millions of dollars in revenue. They just haven't quite found profitability yet, but they're really close. They're on the cusp. Is that VCs can come in and they can utilize their network and make introductions that are game changing for these late stage growth companies. So a VC comes into a company that are looking to raise, several $1 million of growth capital. And these VCs are exited founders generally, not generally, but sometimes they're exited founders, and they've got this vast network. They know CEOs at, big companies, and they've got a really great network of other owners and entrepreneurs and executives. So now these VCs can come in, invest into this company because they know that by investing in this company, they can introduce these founders to people in their network, which can really help to accelerate their growth quickly.
Yeah, no doubt about it. That's a big pro, right?
Yeah, for sure.
It's not just about the money. And again, to go back to the founders side of things, that those are questions that you should be asking, right? Like, what besides the money are you able to bring to the table to help us meet these goals and these objectives that we have or that you have, right? What are you going to do to help us actually execute besides just bringing cash in?
Yeah, definitely. All right, so I think we're probably getting close to time here. So maybe we'll just talk just for a couple minutes about, a couple of examples of some stuff that we've invested in, and then we'll kind of share some final thoughts and wrap up. So I've probably made, including syndications where I've invested into a fund and it's subsequently invested in a handful of companies. So including syndications, I probably have, I don't know, I probably have about 10, probably 10 to 12, maybe in the absolute most, angel and VC investments. Most of them are going to be angel. So I probably have 7 to 9 angel investments, and then, 3 to 5 VC investments. Angel investments, I've done a couple ones like small checks, $10,000, $20,000 checks at, the concept idea level. They've got no customers. They've got no sales. They have, basically no team. It's just like the founder. I've made 1 or 2 of those just because I really liked the founder and I really liked the idea. Having the confidence in somebody at that stage to say, oh yeah, I really believe this person can do it. I think that's kind of a pie in the sky. I think it's just about really, it's about liking the person, liking their story, and liking the mission, the journey that they are just setting out to go on. One of the companies that I invested in was it's a baby carrier, and it's a modern, safe, comfortable, sleek baby carrier that there's been really no innovation in that space in a very, very long time. And this founder, her name's Terry. She's incredible, and her story is great. Her mission is great, and I wanted to be part of supporting her in her journey. So that's like the earliest stage investment. So then we come one step above that, and one step above that is going to be, a company where they've got a team. So it's not just like a solo founder. It's probably a set of co-founders. Maybe they've got one or two other employees. They've got some independent contractors, maybe like a development team that, they outsource some stuff to. And one company that I invested in at that stage, they are, I'm going to kind of butcher this explanation because I don't still fully understand what it is that they do, because I'm not a tech person at all. But they essentially are building a hub where family offices, institutions, high net worth individuals, sophisticated investors can come and connect with investment opportunities in the angel VC growth world, and they come together at this, at this community, at this portal, and it essentially is validation for companies, because if they're on this platform and they're checking all the boxes that need to be checked, they are essentially an investable company. So again, really liked the founder, really strong, technical background. He's a fractional CTO, Chief Technology Officer. He's been a fractional CTO for it's like 100 companies or something in the last decade. So his experience is just incredible. And I believe that they are going to do what they are setting out to do. And then I guess from there, it kind of morphs into more VC investments. In my personal opinion, later stage companies, I think you're going to be best suited by investing in venture capitalists either at the fund level or at the syndication level, in my opinion. So I'll give one quick example of a company that I think I mentioned earlier, which is a company. This is through a VC, but they invested in a company. It's a later stage growth company. They're doing $40 million of annual recurring revenue. They're not profitable yet, but their business is, think of a last stop distribution center for apartments. Okay. So when you order a package from Amazon to an apartment, it's going generally to the apartment complex directly. They might have lockers. They might have some kind of a methodology to disperse stuff, but generally it's a madhouse, because these apartment complexes get, tens or hundreds of packages, maybe thousands of packages a day if they're massive. And there's no efficient, great way to disperse these packages. So this company has developed these distribution centers where all the packages for apartment complexes come to their warehouse, and then they've got last mile last mile service, I guess, to get these packages to apartment complexes much more efficiently. And so they've got, they're in like 8 different cities. I think they've got, 6 or 8 different warehouses or more. They're doing $40 million a year in revenue. And right now they are raising growth capital. I think they're raising a $10 million round right now to get them, into profitability. So there's a few examples.
Yeah, no, I think those are great examples of different types of investments that are out there. And, we're short on time, so I won't share any examples on my side, but maybe I'll just kind of share some final thoughts. And then if you have some final thoughts to add, great. And we'll wrap it up. But, my final thoughts would be this, and we kind of hit on this the last week, that there are public markets, right? Everybody knows about the stock market, the S&P 500, NASDAQ, all those kinds of things. And those are really important parts of anybody's investment portfolio. But there are also lots of other ways to invest, not only to drive our economy, but to increase your own overall wealth and spread out your risk, right? And so these private opportunities, whether they be through angel investing, VC investing, or private equity, like we'll talk about, or, starting your own business or investing in a friend's business, or, there's a lot of different ways to make these types of investments. And they should be something that you think about as part of your overall portfolio, especially as your portfolio begins to grow. Early on should be basic, blocking and tackling type of investments, right? Invest in big companies that everybody knows and understands and knows that they're going to do, well over the long term. And then as your portfolio grows, you start to kind of satellite some things out and make some other types of investments. But it's important to realize that these are, the types of investments that have a great chance of loss.
Yep.
When they hit big, but there's a great chance of loss. And so you got to go in with your eyes wide open and understand what it is that you're investing in, and do the best that you can to understand it and feel confident in the investment that you're making.
Yeah. I was going to say mic drop, but I've got the orange. So I was going to orange drop right there, sir. No, that's super well said, man. Very, very well said. That's exactly how I got into angel and VC investing, right? I didn't start investing in that world till 3 to 5 years ago, but that's because I built up, right, that what you kind of referred to as like this core portfolio of stuff that is, relatively safe, it's liquid, it's accessible, you can get in and out of it at any time, essentially, the click of a mouse. And I built up that core portfolio before I started satelliting into these much riskier, quote unquote, sexier asset classes. So that's a great point to kind of close on. Other than that, there's a lot of programs out there now where, let's say you're interested in angel investing, but maybe you don't have, $50,000 or $100,000 liquid to go out and invest in 10 companies. Well, they've got programs now where you can invest into a fund or a syndication for $3,000, $5,000, $10,000, and that's going to pool a bunch of money together, and you can actually learn how to invest into companies. So there's a program where you can learn how to become an angel investor alongside founders that are looking to be invested in. So you can learn how to, do due diligence, and you can learn how to ask good questions, and you can learn how to invest alongside others that probably have a lot more, experience than you do. So that's a great way to kind of dip your toes into angel and VC investing. But other than that, it's fun. It's exciting to invest in this kind of stuff. But as you put it, you got to be going into these eyes wide open, because the chance of losing capital in these types of investments is great.
Yeah, absolutely. And get good advice along the way, right? I mean, work with people who understand these types of investments, understand your risk tolerance, your time horizon. So
Yep.
Let me just end with saying, we appreciate our audience. We appreciate those who have been on this journey with us for a little over 3 years at this point. We appreciate, the transition to this type of a format, and we look forward to continuing to provide this. So join us next time.
Yeah, likewise. By the way, almost 4 years. Almost 4 years.
Yes. Correct. You are correct.
All right.
You've been listening to Tycoons of Small Biz, a podcast for small business owners by small business owners. Be sure to follow us on our social media channels for links to all our episodes and great content around growing, investing in, buying, and selling small businesses. This podcast is distributed for informational purposes only. Statements made in the podcast are not to be construed as personalized investment or financial planning advice, may not be suitable for everyone, and should not be considered as solicitation to engage in any particular investing or planning strategy. Listeners should conduct their own review and exercise judgment, or consult with their professional financial advisor to see how the information contained in this podcast may apply to their own individual circumstances. All investing involves risk of loss, including the possible loss of principal. Past performance does not guarantee future results, and nothing in this podcast should be construed as a guarantee of any specific outcome or profit. All market indices discussed are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested into directly. Investment advisory services offered by Backbone Planning Partners, LLC. Neither Backbone Planning Partners, LLC, nor its representatives provide legal or accounting advice. The content of this podcast represents the views and opinions of Austin Peterson and Landon Mance, and/or the podcast guest, and do not necessarily represent the views or opinions of Backbone Planning Partners, LLC. Statements made in this podcast are subject to change without notice. Neither Backbone Planning Partners, LLC, nor its representatives, the podcast host, or its guests have an obligation to provide revised statements in the event of changed circumstances.